Hi, and welcome to Pring Turner's April 2013 video newsletter. This one's entitled, Another Roller Coaster Ride to Old Highs. The first quarter ended on a happy note with the S&P 500 index finally reaching the two top high points set in both March 2000 and October 2007. It took the stock market 5.5 long years to regain the 56% drop suffered during the Great Recession of 2008-2009. The U.S. stock market currently sits near levels first reached almost 14 years ago. It has certainly been a wild financial roller coaster ride for investors. Buy and hold has not been a winning strategy this century. Success has been best achieved by having a plan to both grow assets during the bull markets and a serious plan to protect portfolios during the ride down in bear markets. The core proactive investment strategy at Pring Turner is to carefully pay attention to business cycle swings. Those are especially important during recessionary periods, to manufacture returns while reducing risk through the normal ebb and flow of the economic cycle. In March, the stock market celebrated its 4-year birthday, making it quite mature for an average cyclical bull market. At this late stage, we are still optimistic but watchful for signs of any change to our outlook. Our cautious optimism is tempered by the observation this business cycle expansion has been fueled not so much by genuine underlying business demand and prosperity as it has by unprecedented money printing, QE1, 2, 3, and so forth, by the Federal Reserve. In prior recoveries, the economy needed just a little monetary oxygen provided by the Federal Reserve to kickstart a recovery. This economy has instead been on full life support for 4 years, experiencing the weakest post-war recovery yet, and the Fed has announced it will continue to provide life support for another year or two. The patient is alive but apparently not yet able to sustain itself without additional intensive care. The big question is, what happens when either the Fed takes away the oxygen hoses or the economy slips into the next recession without fully recovering or improving the employment situation? Or what if inflation jumps above tolerated threshold levels? These are all issues we will stay focused on and stand ready to shift portfolio tactics as the economic environment changes. As we theorized in our January client letter, the economy as measured by our barometers has indeed advanced into Stage 4. Historically, Stage 4 is particularly kind to natural resource type companies. So far, though, we have yet to see natural resources like metals, mining, and energy companies begin to outperform other sectors. But we do expect that to occur as we move through Stage 4. Shorter term, we believe the 4-year cyclical bull market for stocks is not finished, but perhaps getting too stretched to the upside. After a 5-month rally, the stock market is entitled to take a short rest. Expect stocks to correct some of the recent gains and retreat in price. However, our business cycle research shows evidence of a continued modest, yet positive economic momentum. This allows the stock market further upside potential as the year progresses. We will be searching and evaluating additional conservative growth and income ideas to purchase on weakness. Longer term, one potential major catalyst that could propel stock market even higher in 2013 could be the return of the public stock investor. The mutual fund money flows, an indicator of public interest, shows investors since 2007 have consistently pulled money out of the stock mutual funds until very recently. Investor confidence is finally rebuilding, and positive stock flows are an encouraging sign the cyclical bull market can extend. But if and when the public gets too carried away, we will become more concerned. That's it for this month's newsletter. Thanks for listening.